Let's turn to the market impact of tariffs. Stocks rallying as investors breathe a sigh of relief on the trade front. But is the worst of the market selling behind us? That's a big question. Joining us now to discuss, we've got Matt Orton, Raymond James Investment Management Chief Market Strategist here. Matt, let's just begin there. Is the worst of the selling behind us now?
Hey, good morning, Brad. Always great to join it. I think that's unknown at this point. I think this relief that we're seeing is more a result of the fact that there was no sort of whiplash from the White House last week. And it seems like we've had more marginally positive news with respect to what tariffs might potentially look like on April 2nd. But I don't know if there's too much that we can put into that until we actually have certainty. Until we're actually past April 2nd, it's very difficult to say that we're actually going to have a narrower scope of tariffs, that we're not going to stack tariffs. So when I talk to clients, I think my main message is wait until we actually know what's going to happen and continue to use the playbook of better diversification, because there's a lot of parts of this market that have been working, like dividend growth, geographic diversification into places like Europe. Those are still areas that work, and balancing that with fixed income that has also done very well this year. I think that continues to be the playbook, and hopefully after the first week of April, as we get into earnings season, that'll be the time to really start finding what's been thrown out with the bathwater and being opportunistic with respect to downside.
How shaky does that make today's rally, Matt, just given the opportunities that you just expressed that are there in the market in some of those dividend plays, those safer areas? If we get to a certain level of gains in the market, will we just see selling so that folks can get more defensive?
Yeah, Madison, I think investors are going to slow roll this. While today's enthusiastic, I think it's just a sigh of relief maybe that we were heading into this weekend with a little bit more concerns about what might be down the road. But I think a lot of these more stable parts of the market, sectors that have done really well this year, like energy, healthcare, the bucket of dividend growers, you tend not to see these massive rises with respect to the cycle of optimism versus pessimism. So that's one reason why I continue to like that pocket of the market. I might actually fade or really trying to avoid leaning into the rally that you might see in information technology or consumer discretionary or communication services, because those names are going to be whipsawed around by every single headline with respect to not only tariffs, but PCE on Friday, which also could be another surprise for the market as well. So I would hold back on making any big moves until we actually get past the first week of April and really into earnings season. And that's when I might be looking to buy some of the mega cap names that have been thrown out with the bathwater, some of the big banks that have pulled back to levels that we had prior to the elections. Those look like compelling long-term opportunities to me.
Outside of just relief, what is the next kind of conviction trade that you see brewing beyond just us saying, okay, the worst of the selling is behind us? It doesn't seem like there's a catalyst for this market right now.
So, Brad, I think the catalyst is going to be earnings season, because tariffs are not, I think the biggest uncertainty that investors face right now is what earnings growth is going to look like later this year and into 2026. So we've already seen valuations pull back on a number of names that have led the rally before. So I think that could provide a ballast if you actually start to get good earnings in some of those mega cap names, and you confirm that growth is still there with respect to some of those secular growth trends and artificial intelligence and the build out that's happening there. But sectors like healthcare are expected to have an inflection with respect to their earnings growth. So if that materializes, that'll provide some more tailwinds to a sector that also embodies some growth, but has defensive characteristics too. So I think earnings season is going to bring the focus onto who the winners can be in this environment going forward, because not everyone's going to be able to win. Right now is the time you want to be selective and you want to focus on who your actual consumers are. But there's a lot of opportunities out there.
It just sounds more, Matt, like relief is the theme of the front half of this year then. Because if it's relief that the trade war is not as pronounced as it could be, and then relief, especially on the earnings front, when we've already had companies like they tend to do, cyclically at the beginning of the year, downplay some of the expectations and then try to beat on those sandbagged expectations. It sounds like it's just more relief that investors are banking on right now.
I wouldn't describe it so much as relief, Brad, as I would really call it reality. we're getting a reality check in the first quarter of this year of what tariffs and really what Trump campaigned on is actually being implemented. That's why we have so much volatility. But that reality is also what's driving the increase in breadth in the market, because earnings are actually improving for the S&P 493. That's a real durable trend that investors can lean into. And again, that's why earnings season, I think, is going to be really important to confirm the reality that financials, healthcare, energy companies, a lot of more cyclical parts of this economy can still work going forward. And that's where I would be looking to pick up opportunities that have fallen over the past quarter or so.
Really great insight and advice for our listeners. Matt, thank you so much for joining us. Appreciate it.
Thank you.